Learning Objective 2 is to prepare analysis showing whether a product line or other business segment should be added or dropped. One of the most important decisions managers make is whether to add or drop a business segment. Ultimately, a decision to drop an old segment or add a new one is going to depend primarily on the impact the decision will have on net operating income. To assess this impact, it's necessary to carefully analyze the costs. Let's take a look at the example. Due to the declining popularity of digital watches, Lovewell Company's digital watch line has not reported a profit for several years. Lovewell is considering discontinuing this product line. To determine how dropping this line will affect the overall profit of the company, Lovewell will compare the contribution margin, which would be lost, to the cost, which would be avoided if the line was to be dropped. Lovewell should drop the digital watch segment only if its profit would increase. This would happen only if the fixed cost savings exceeds the total contribution margin. This is digital watches segment contribution income statement. Total sales $500,000 minus variable expenses, including variable manufacturing costs, variable shipping costs, and commissions. Total variable expenses $200,000. We subtract the total variable expenses from sales, and we can get contribution margin $300,000 minus fixed expenses, including general factory overhead, salary of a line manager, depreciation of equipment, advertising, rent, and general administrative expenses. We can get net operating loss $100,000. Among fixed expenses, general factory overhead and general administrative expenses are not avoidable costs. These expenses assigned to digital watches will be reallocated to other products. Additionally, the equipment used to manufacture digital watches has no resale value or alternative use. We can use contribution margin approach to analyze the decision. If digital watches are dropped, contribution margin lost $300,000. Fixed expenses, which can be avoided, include salary of the line manager, advertising, and rent. Total fixed costs, which are avoidable, are $260,000. So the total net disadvantage is $40,000, which means if Lovewell drops the digital watch line, its net operating income will decrease by $40,000. Because contribution margin loss exceeds avoidable costs, Lovewell should keep the digital watch segment. Here, we do not include general factory overhead and general administrative expenses. These costs are not avoidable. Equipment depreciation is not included either because it's related to purchasing of equipment and it's a sunk cost. Also, there is no resale value of equipment, so we did not include either equipment depreciation or cost or resale value of the equipment in our analysis. To make the decision, we need to be aware of allocated fixed costs. Lovewell's allocated fixed costs can distort the keep or drop decision. One of the managers may ask, why should we keep the digital watch segment when it's showing a $100,000 loss? The answer lies in the way we allocate common fixed costs to our products. Including unavoidable common fixed costs in the segment income statement makes the digital watch product line appear to be unprofitable, but dropping the product line will actually decrease the company's overall net operating income. Learning Objective 3. Prepare, make, or buy analysis. When a company is involved in more than one activity in the entire value chain, it's vertically integrated. A decision to carry out one of the activities in the value chain internally to make rather than to buy externally from a supplier is called a make or buy decision. Let's take a look at example. Essex Company manufactures part 4A, which is used in one of its products. The unit product cost of this part includes direct materials, direct labor, variable overhead, depreciation for special equipment, supervisor's salary, and general factory overhead. So the total unit product cost is $30. Additional information. The special equipment used to manufacture Part 4A has no resale value. The total amount of general factory overhead, which is allocated on the basis of direct labor hours, would be unaffected by this decision. The $30 unit product cost is based on 20,000 parts produced each year. An outside supplier has offered to provide 20,000 parts at a cost of $25 per part, which is cheaper than the product cost of the part manufactured by the company. Should we accept the supplier's offer? Let's take a look at the calculation. Outside purchase price, $25 per unit. To produce 20,000 units, total cost of buying from outside supplier is $500,000. To make Part 4A, avoidable costs include direct materials, direct labor, variable overhead, and supervisor's salary. So we can calculate total cost of making 20,000 units of 4A is $340,000. Here, the depreciation of special equipment is related to the cost of equipment, and it's a sunk cost. The equipment has no resale value, so both its cost and associated depreciation are irrelevant to the decision. General factory overhead is not avoidable cost. It's irrelevant. If the product is dropped, it will be reallocated to other products. So back to our decision, should we make or buy Part 4A? Total cost of making 20,000 units of Part 4A is lower than the cost of buying. If Essex makes 20,000 units, it can save $160. So Essex should continue to make the part. But what if Essex has opportunity cost? Recall that opportunity costs are not actual cash outlays and are not recognized in the formal accounts of your organization. Opportunity cost is a benefit which is given up as a result of pursuing one alternative over others. If the space to make Part 4A can be rented out to earn $200,000 per year, will the company change its decision? Here, If the company makes a part for A, rather than buying the part, the company can save $160,000. However, if it rents out the space, it can earn $200,000. If we calculate 200,000 minus 100,000, the company can get a financial advantage, $40,000. So the decision is to buy the part instead of making the part. But for each type of decisions, qualitative factors may be also important in the evaluation process. For example, the company may still want to make the part because it can control the quality. If the company decides to buy from outside supplier, the company will consider reputation of outsourcer. So when managers make final decisions, they need to consider all factors, both financial and non-financial.